conference call of Bajaj Finserv Limited, hosted by JM Financial. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sameer Bhise from JM Financial. Thank you, and over to you, Mr. Bhise.
Thank you, Michelle. Good morning, everyone, and welcome to the Q1FY24 earnings conference call of Bajaj Finserv Limited. First of all, I would like to thank the management team of Bajaj Finserv for giving us the opportunity to host the call. From Bajaj Finserv, we have Mr. S. Srinivasan, CFO, Mr. Tarun Chugh, CEO of Bajaj Allianz Life Insurance, Mr. Ramandeep Singh Sahani, CFO of Bajaj Allianz General Insurance, Mr. Bharat Kalsi, CFO of Bajaj Allianz Life Insurance, Mr. Ashish Panchal, CEO of Bajaj Finserv Direct, and Mr. Devang Modi, CEO of Bajaj Finserv Health. I would like to now hand over the floor to Mr. Srinivasan for his opening comments, post which we will take the Q&A. Over to you, sir. Thank you.
Good morning, everybody. I welcome everyone to this conference call to discuss the results of Bajaj Finserv Limited for Q1 FY24. As before in this call, we will largely be concentrating on the consolidated results as well as the results of our insurance operations through Bajaj Allianz General Insurance and Bajaj Allianz Life, and where material the standalone results of our company BFS, which is another major subsidiary of ours. Bajaj Finance has already had its conference call. However, if there are any high-level questions on BFL, we would be glad to take that as well. We also have with us Devang and Ashish from Bajaj Finserv Health and Bajaj Finserv Direct. And if you have any specific questions on those businesses, they will answer those. We will not be taking any questions on the status of Allianz's stake in our insurance companies. The status has remained the same as at the end of the previous quarter, and there is no change there. Any statements that may look like forward-looking statements are just estimates and do not constitute an assurance or indication of any future performance result. Remark on Ind AS. While BFS prepares its financials in compliance with Ind AS, the insurance companies are not yet covered under Ind AS. They have prepared Ind AS financials only for the purpose of consolidation. Accordingly, for Bajaj and BALIC, standalone numbers reported are based on non-Ind AS accounting standards as applicable to insurance companies. Our results, the press release accompanying the results, and our investor deck have been uploaded on our website yesterday, and I hope most of you would have had a chance to go through that. Let me first put in a word on Bajaj Finserv Asset Management Limited, which launched its first mutual fund during the quarter. It filed for its first of its 7 products with SEBI in March 23 and April 23, and the first 2 funds, the liquid fund and the overnight fund, were launched by the end of June 23, while the money market fund, NFO, was launched in July 23. The NFO is its first, and it has recently opened on 24th July, the Bajaj Finserv Flexi Cap Fund with a mega trend strategy that is currently ongoing. Over the next few months, BFS AMC will be launching other categories of funds, including balanced, large and mid, banking, PSU, and arbitrage funds. Let me now move to the update on performance for Q1 of FY24. Macroeconomic conditions were stable during the quarter with a higher level of business confidence, and overall business conditions were very conducive. Our companies have once again delivered very strong operating performance. Let me start with Bajaj. Bajaj regained retail growth momentum with broad-based growth across products and channels. New initiatives, including the Geo expansion initiated in FY23, started yielding results. For the quarter, Bajaj reported a strong growth of 22.2% in gross direct premium income, GDPI, as against the private sector growth of 21.2% and an industry growth of 16.5%. Excluding the tender-driven business, which are crop insurance and government health schemes, the GDPI growth for the quarter was a very healthy 26.7%. In Q1, Bajaj continued its momentum with growth in motor business recording strong performance of 26% YOY growth across private cars and two-wheelers. Group health, in which Bajaj recorded a sub-100% loss ratio in FY23, continued to grow strongly with a 43% growth. Commercial line, fire, engineering, marine and liability continued the growth momentum of earlier years, recording 22.1% growth. The growth in commercial lines was aided by Bajaj's strong bank assurance network and multi-line agency channel, supported by strong underwriting and large reinsurance capacity for covering large risks. Bajaj was able to capitalize on its strong presence in smaller towns and rural areas through its banca virtual satellite offices. In terms of retail health, Bajaj grew 11.9%. However, due to the high incidence of frauds and reimbursement claims, Bajaj continues to be cautious and is focusing on strengthening the use of analytics and processes to control frauds and focus on growing in profitable areas. Note on earned premium. As you may be aware, when growth is strong, the earned premium grows less than the gross premium as premiums are deferred across the tenure of the policies while costs are written off upfront. As a result, net earned premium grew only 5%, but this unearned premium is expected to get mostly earned in the subsequent quarters of the year. For Q1FY24, the loss ratio was lower at 74.3% as against 77.9% in Q1 of FY23. The improvement in loss ratio was attributable to lower claims in motor and commercial segments and is after absorbing losses of rupees 10 crore from Cyclone Biparjoy and other catastrophic losses. As a result, the combined ratio for Q1 FY24 was a healthy 100.7% as compared to 104.6% in the same quarter of the last year. We expect this will be among the best as when compared with other composite general insurance companies. In a market which is intensely price competitive, this result, we believe, displays Bajaj's commitment to a balanced and profitable growth on the back of strong sourcing, claims management, and controlling grievances. The profit after tax of Bajaj was 415 crore in Q1 FY24 versus 411 crore in Q1. The muted PAT growth was attributable mainly to lower realized gains from sale of equities, which is offset by higher current income and lower combined ratio. Excluding the effect of realized gain, the core operating profit before tax would have been increased by over 40%. Bajaj's AUM grew 13% to 28,611 crores as on 30th June 2023 versus 25,362 crore on 30th June 22. The float generated, which is represented by the increase in AUM, was 3,249 crore during the last 12 months, which includes advance premium as at March 2023, which was 1,678 crore. Strong growth in two-wheeler and CV business helped in this growth. Another key highlight of this quarter was the conduct of the first ever General Insurance Festival of India in Pune, which won an entry in the Guinness Book of World Record for the largest attendance at an insurance conference, with over 7,000 agents attending the event. This event, which is one of a kind, also reiterated a significant connect that Bajaj has with the agent community. Going forward, we would hopefully want to make it an annual event. In summary, it was a quarter with intense competition and Bajaj has performed very well with solid growth supported by strong underwriting performance. I'll go to Bajaj next. During the quarter, Bajaj continued its growth trajectory and reported an individual rated new business premium growth of 15% against the industry and private players growth of 2% and 8% respectively. The market share in IRNB terms therefore increased from 8.3% in Q1 FY23 to 8.8% in Q1 FY24 among private players, leading to Bajaj improving its ranking on IRNB basis from 6th to 5th position. Bajaj's 2-year IRNB CAGR of 44% in Q1 is among the highest in the industry. Bajaj's 15% growth is to be seen in the backdrop of an 80% plus growth in Q1 of FY23, which resulted in a very strong base. The total number of policies sold by Bajaj grew 18% to 1.44 lakhs in Q1 FY24. Overall, IRNB mix for Q1 FY24 stood at par 13%, non-par savings 33%, term 5%, annuity 6%, and ULIP 42%. In absolute terms, we have seen a significant growth this quarter in retail term segment of 128% as compared to Q1 of FY23, although it is on a small base in the same quarter of the previous year. After the uncertainty initially followed by very strong growth in Q4 due to the tax changes, and since business in the first quarter of life insurance is usually muted, Bajaj decided to use this period to strengthen its ULIP product, the launch of a new and innovative product. As a result, there was a lower share of par business, which the company expects to correct in the coming quarters. During the quarter, growth was driven by all the main channels, with agency, institutional business, and BALIC Direct growing at 22%, 8%, and 18% respectively. During the quarter, BALIC started activating several of the recently signed corporate agency tie-ups with DBS, City Union Bank, Tamil Nadu Mercantile Bank, Punjab Singh Bank, and Jammu Kashmir Bank. Moreover, with the opening of a rep office in Dubai, BALIC looks to further strengthen their institutional business. Another point I would like to highlight here is the various initiatives undertaken by BALIC to improve persistency across most cohorts, especially in the later buckets. 13-month persistency stood at 83%, 49th and 61st month persistency has improved to 63% and 50% respectively. The increase in persistency over the last few years helped deliver a very strong growth of 31% in renewal premium in Q1FY24. New business value net of expense overrun degrew by 30% from 135 crore in Q1 to 94 crore in Q1FY24. This is mainly due to a lower proportion of par in the product mix, as I explained earlier, and also the effect of interest rate movement on the guaranteed non-par businesses. The profit after tax grew 26% from 124 crore to 155 crore, supported mainly by higher shareholder income, lower death claims, partially offset by higher new business strain on account of business growth. Overall, a good balanced quarter for BALIC with a strong focus on retail distribution growth. Finally, both insurance companies are financially among the most solvent, BALIC with 475% solvency and BAGIC with 388%. And hence are well poised to weather any external adversity. Let me move to our lending businesses, BFL and BHFL. BFL has already had its investor call, and hence we will only broadly touch upon BFL results. Q1FY24 was another excellent quarter for BFL, with the company delivering on all its long-term financial guidance metrics: AUM, profit growth, return on assets, return on equity, as well as gross and net NPA. Continuing its growth story, BFL acquired 3.84 million new customers in Q1FY24. Total customer franchise stood at 7.3 crores or 73 million, while the cross-sell franchise stood at 44 million. Building on this customer franchise, the number of new loans booked in Q1FY24 increased by 34% from 7.42 million to 9.94 million. The company's diversified business model has enabled it to record a strong AUM growth, as seen from the total AUM standing at 2,70,000 crores as on 30th June, 32% higher than the 2,04,000 in the previous year. 61.4% of BFL's customers were repeat customers. BFL's loan losses and provisions were 995 crore on 30th June in the Q1 of FY23. It has a management overlay provision of 840 crore at a consolidated level as of 30th June. The company released 120 crore from the overlay in Q1. The gross and net NPA continue to be, or which is recognized as per the expected credit loss method prescribed in India, continue to be exceptional, with at 0.87% and 0.31% respectively. In the same quarter of last year, it was 1.25% and 0.51%. It is worth mentioning here that during this quarter, BFL has had its lowest ever GNPA over a number of years. BFL ended the quarter with a PAT of 4,551 crore, which is 30% higher than the same quarter of last year. The capital adequacy, including Tier 2 capital, was very strong at 24.6%, and Tier 1 capital was again very strong at 23%. Bajaj Housing Finance Limited, the 100% mortgage subsidiary of BFL, continues to do well. The AUM grew 29% to 74,000 crores as on 30th June, and the profit after tax grew 23% to 526 crore in Q1. Capital adequacy ratios stood at 22.52%, and GNPA and NPA were again quite exceptional at 0.23% and 0.08%, as again 0.27 and 0.11% in the same quarter. In summary, a superb quarter for both BFL and BHFL. Now to give some update on our newer companies, Bajaj Markets, Bajaj Finserv Direct, and Bajaj Finserv Health. During Q1 FY24, Bajaj Markets attracted about 88 lakh customers on its digital platform, out of which 2.2 lakh became customers. And BFSD lending, unsecured and secured, with both BFL and external partnerships, recorded a disbursement of 1,427 crore as against 1,313 crore in the same quarter of last year. 74,000 odd cards were sourced as against 65,000 in the previous quarter. In Q1FY24, Bajaj Finserv Health carried out 10.36 lakh health transactions, that is crossing a million health transactions versus just 4.86 lakhs in Q1 of FY23, having 3.22 lakhs plus monthly users. For the quarter, Bajaj Finserv Health had 1.14 million paying users versus 8.55 lakhs in Q1 FY23, with 3 lakh users having renewable products. Bajaj Finserv Health is also expanding the provider network, which includes 1 lakh plus doctors, 5,000 plus lab touch points, 1,950 plus hospitals. Utilizing the network strength, EBH is able to offer and service differentiated product plans for both retail as well as to corporates for employee health benefit segment. You will find more details of all these in our presentation, which is uploaded on the website. For those of you who have not seen our press release, I will just summarize the consolidated results. Consolidated total income, 47% increase at 23,280 crore versus 15,888 crore. Consolidated profit after tax, a 48% increase at 1,943 crore versus 1,309 crore. The consolidated profit after tax includes the unrealized mark-to-market gains and losses on investments of the insurance companies on account of the adjustments required under the Ind AS. If we have to exclude the volatile impact of the MTM losses and gains, the core profit after tax would have increased by 24% in Q1 FY24. Before we open for questions, considering the paucity of time, I would request the audience to keep their questions brief and preferably not repeat questions that have already been asked or covered, so that we can cover more queries during this call. With this, I now invite questions from all of you. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Prakash Kapadia from Anived Portfolio Managers Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Motor has been doing well for us. So, is it some OEM market share gains what we have done? Is it some new geographies, which we have now targeted? What is driving this growth? And, is this growth sustainable for us? Because we've grown pretty well. Secondly, on expenses on management, what impact does it have on the industry as we move forward? Will it lead to, better consolidation, better pricing? And, what impact would it have as we move forward? And on BALIC, what is the unwind rates we should look at given, the current interest rate cycle? These were my three questions.
Yeah. I will first give a high-level response before passing on to Raman. I think in Bajaj, what we are seeing is that last year and a half, we have been investing quite a lot in expanding our distribution outside of even the OEMs in terms of smaller towns. We have digital offices, the digital banker, we have virtual satellite offices. And last year, we were doing a lot of correction there because you have to get the people, you have to get the strategy right. I think that has started falling in place. My own assessment is that it has been broad-based growth across OEMs as well as agency and other channels in motor. On the EOM and the rest of to give a more detailed flavor on the motor business, I now hand over to Raman.
Yeah, hi. Thanks, Srini. So I think Shri rightly articulated. So if I try to summarize the way the motor business has been operating for us, one of the big levers for growth has been the two-wheeler business. As we've discussed in the past, two-wheeler from an OEM perspective used to be a handicap for us because there were many OEMs who didn't want to work with the Bajaj brand because they looked at it as competition, given the group level branding on Bajaj from Bajaj Auto perspective. But over the last 15 to 18 months, we've been able to kind of break that jinx. So barring Hero, I think we've been now able to tie up with all the OEMs on the two-wheeler space. And hence, if you see for the quarter, the growth on two-wheeler has been upwards of 40%. And that's been the trend for last 2-3 quarters now. So that is the biggest lever of growth in our overall motor numbers. If you look at it from a channel contribution perspective also, one is motor dealer, where we've been seeing a gain of market share. To give you some flavor of the market share numbers, on four-wheelers, our new car market share last year same quarter was about close to 7%, and in this year for the first quarter it's moved close to 9%. Two-wheeler, which 2 years back used to be sub 4%, last year we had already moved up to about 6%, and now in quarter one it's moved to about 11.5%. PV also very healthy number of close to 25% market share. The motor dealer channel seems to be contributing significantly to the growth, but like Srini said, the growth is more balanced across all the channels. If you also recall our past discussions, we had said that we will try to penetrate more, as a strategy we'll try to penetrate more into the smaller towns of the country, and we call it the Bharat model. So that's something, the numbers have started to register some decent growth, and that's one of the other levers for the growth. Also on the more established channel like agency, there also we've added a lot of manpower and agents, which is leading to the growth. And overall, if you recall our previous conversations, we had said, post the pandemic, we had kind of consolidated our manpower and reach and so on and so forth. And we had said that there will be some stress on the bottom line as we start expanding. And I think some of the expansion which we've done in the last 12 months has started to show the results. So that's the reason, these are the reasons for the overall growth in the motor side. Now, obviously, because we've done the expansion, we've seen the growth sustain, and we'll continue to expand for at least for another year or so. So maybe in the medium term, you will see this growth sustain is what we believe. Now, obviously, it's also an outcome of how the market moves, and as you know, it's a very, very dynamic market in terms of discounting and commercials. Now that is something which we'll have to wait and watch. But as things stand today, maybe the growth in the medium term at least looks sustainable. From an EOM perspective, as we've discussed in the past, given that most of the industry, or at least half of the industry, was non-compliant, and hence we were of the view that there should be some sanity which should come in the way the commercials have moved over a period of time. Well, too early to say that because it's only been one quarter. As of now, we are not seeing any outcome of that because I think people are just getting aligned to the new regime. Maybe another quarter or so will be required to figure out the real impact. But what we are clearly seeing is that on the bulky businesses like crops and so on and so forth, there the level of engagement from many other private players has got accelerated. So the competition is becoming even more intense in crop business because, as we know, that gives the arbitrage on the EM ratio. So that's the only thing I would like to submit at this stage. And let's probably wait for another quarter or so to really figure out what's the real outcome of regulation.
Thank you, Raman. I'll just add to what Raman said. On the EOM, I think it is now that the regulator has given a budget, 30% of your gross written premium. Now, different companies will have to evaluate where do they want to pitch more, because there are no individual limits on product level or intermediary level. But if they pay more somewhere, they have to pay less somewhere else. So clearly, I think it is for each company to decide. Some people may say, I want to pay on motor. Somebody will say, I pay more to banks, whichever channel or product they want to pay for. So this will evolve and this will keep changing as companies keep changing the strategy because it's a very competitive market. So as things evolve, we will keep watching. But we were below the limit, and we do have very significant solvency. So we have the strength to play out any of the combinations that one might see in the market. Now I'll hand it over to Bharat to take the question on the unwinding rate on the life business.
Yeah. So thank you. So the unwind rate is basically depends on the market yield of the assets which we are holding, and as well as what are we expecting in terms of a return. But if you see that consistently, it has been between 8 to 8.5%, and I think it'll be hovering around there only. That's the number is.
Okay, fine. I'll join back if I have more questions. Thank you.
Thank you. The next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Hi, thanks for the opportunity. So I'll start off with Bajaj. So the loss ratios on the commercial lines have improved this quarter despite the reinsurance rates hardening and the fire pricing being rejected by the regulator. So just wanted to understand, how have you achieved this improvement in loss ratio despite these headwinds? That would be, the first question. I'd have a few more, but I'll pause before I go through those.
In commercial businesses, the loss ratio has been seen across the cycle because they're also exposed to catastrophes. Raman, would you like to explain?
Yeah, so if I just look at the movement, like you rightly highlighted from last year, same quarter. Last year, I remember in the same quarter, there were some large claims which were reported in quarter one, and hence in some of the lines, the loss ratio had moved up. I remember that being true for engineering and fire. Fortunately, that's not the case in this quarter, and like Srini said, cyclical, at times you have some calamities and because of which this happens. Now, given the fact that, in the quarter one, there has been the cyclone, but we've seen only a hit of net of 10 crores, while the gross is a little higher amount of close to 50 crores. But the net impact for us has been lower at 10 crores. But just a word of caution, these are quarter one numbers, and we've seen, the way the nature has been creating havoc in quarter two. I think this doesn't end here, and we are just keeping our fingers crossed to see how quarter two plays out because of, the heavy rainfall most part of the country has been experiencing. So that's just a word of caution. While quarter one has been good, we've just seen a small impact of 10 crores from Biparjoy cyclone. But quarter two is something which we'll have to wait and watch. But otherwise, to answer your question, I think, like Srini said, it's a cyclical thing. This quarter has just been better compared to last year, where we had some bulky claims reported in quarter one.
Yeah, I was, thanks for that. This was going to be my second question, that, from the North Indian floods, what kind of impact are you actually seeing could give us some, color on, what kind of claims that you are getting or what kind of...
I'm sorry to interrupt. Mr. Datta, your voice is breaking. Could you please repeat your question?
Yeah. So what I was saying is, my second question was on the North Indian floods. So wanted to understand what kind of claim trends are...
It is related to Delhi, Haryana and all, no? Himachal and all. Raman.
Yeah, I understood. So as of now, nothing material has been reported. Obviously, on the motor side, there are many claims which have got reported. But I think maybe in a few weeks' time from now, we will really have the right assessment. So maybe Q2 call is when we will really be able to give the right picture. But the claims, like I mentioned, have gone up. Fortunately, at this stage, only the retail ones we have seen having been reported. Nothing significant on the commercial side so far. So maybe you'll get a better picture in the Q2 call.
Got it. That's very helpful. And last question on Valet. So, if you could quantify what was the impact of the interest rate move on the VNB margin, that would be very helpful. I just wanted to understand what is the hedging strategy when it comes to non-par products.
Bharat?
Yeah. So I'll take that.
Yeah, please.
Yeah. So first of all, let me just cover the hedging strategy part of it. All our non-par book and annuity and a good extent of term book, which has a long tail also, is being effectively hedged through FRA, partly paid bond, and obviously we look at other hedging strategies, including a cash flow matching and a duration management. So to that extent, the comfort is at a 90%, 95% plus the book is hedged through the relevant instruments, and wherever it is an unhedged portion left, say something which is beyond 40 years of a liability, we assume a very minimal rate of interest to make sure that there is no interest rate risk. So from a hedging perspective, it's completely in control. As far as your question on the margin concerns is that, compared to previous year, if you look at Q1 versus now, the yield curve has actually changed. And it is not just a shift in the curve, the slope of the curve has also changed significantly. But if I broadly put, two things can be done. One is that you immediately react in terms of customer IRR change, or there could be a little bit of a lag because when you decide by the time you make a change, there could be a lag of a 2 weeks, 3 weeks or a month. That could have an impact on the margins. In our case, that would number be around 1.5% or so compared to previous year Q1 number. The other dent in the margin is basically because of the product mix change, as Srini in the beginning also mentioned, that we wanted to pick up the Q1 on a high momentum. So those are the two broad breakup in terms of change in margin versus previous year. The other thing just I wanted to update is that, as I said, if the margin has dropped around 3.5%, maybe give and take 2% is because of the product mix change, 1.5% because of the yield curve change, but both the corrective actions in terms of product mix as well as in terms of changing the IRR in line with the yield curve has already been done, executed in the month of July itself. So this was just a Q1 where the momentum was the strategy for us, and the corrective action is already being taken. Tarun, in case if you want to add anything.
No, I think you've largely answered. If there's some further question, I'll take it.
Yeah, sure.
Thanks a lot. That's very helpful. I'll join back with you for the questions.
Thank you. The next question is from the line of Nidhesh from Investec. Please go ahead.
Thanks for the opportunity. Firstly, on BALIC again, because we have not seen such margin trend for other insurance companies. So is it primarily because that we have not repriced our guaranteed product when interest rates have changed? That is the main reason for margin decline. And also the product mix, because the par has declined, but at the same time protection has gone up and non-par has also gone up. So product mix 200 basis point, what explains product mix change impact of 200 basis point on margins? And then how should we look at margins for the full year basis?
Tarun, Bharat, would you like to take it?
Yeah, I think let Bharat answer. Go ahead.
Yeah. Okay. So thanks for the question. As I said, one is that because there has been a little lag in terms of reducing the customer IRR. It's just a timing difference, not that it's structurally a drop in the margin. So to answer your question, whether this is It just because of the time lag of 2-3 weeks or a month is what is reflecting in the non-par side of the world. Otherwise, if you look at from a ULIP, which has gone up compared to last year, ULIP is, as we know, always a very low margin business. And par obviously helps us in terms of the overall cost being managed in terms of the total policyholder funds. So I think those two working in the negative, like ULIP going up as well as par going down, has a double impact in terms of the margin, which is where we have already corrected it. So if you look at in the beginning of the July only, we have dropped the IRR of our key products, which is AWG and others. And similarly, our ULIP mix has also dropped and par mix has gone up. What we have done is we have launched a new par product that is helping us. Secondly, in Q1, the call was that because the market was also showing positive results, and after the Q4 euphoria of being a high quarter for the industry, we didn't want to lose the momentum, and we went with the approach of what the customer would as of now wants to buy in terms of the preferences, which is more linked to the market. And hence we launched a very specific product in the month of May, which has kind of took a initial euphoria of taking ULIP higher. And now all that has already been settled. Our product mix is already back to what we were last year. Even if you look at last year till YTD December, because last quarter was not the right mix for the industry, we are back to the YTD December mix already. So it's just a quarter where we have seen it. And given this quarter is a small for the industry and for us also, we could take some calls that this quarter, whatever plus minus comes in, we can cover up it in the 9 months. And in the deck, you would see that our rolling 12-month margin is steady at 14.8% compared to last year also. So it just a quarter doesn't take away the margin directionally up or down. The numbers are hovering around 15%.
Just to add to what Bharat said, see, quarter one is when life companies can afford to try different tactical strategies. And therefore, because it's the lowest quarter in the whole year, and every year you will see that in the first quarter, back in at least last couple of years, I have been noticing they have been doing something different. But as the second quarter comes, I think things will start falling in line, and the distribution gets aligned to what is required.
Sure. Thank you. Thank you for the explanation. Secondly, on the Bajaj, we have seen a sharp improvement in market share on the motor OD side. But we keep on hearing that the competitive intensity in that segment is quite intense, specifically on the private car side. The competitive intensity is quite intense. So how are we able to gain market share, and how should we look at the profitability from a combined ratio perspective, given the competitive intensity still remain intense in the motor OD segment?
See, I will just broadly started off saying that in motor, while competitive intensity is largely price driven and therefore there is price competition, I think the way Bajaj selects the business, grows the distribution, mixes up OD and TP, and the different ages of vehicles, new versus old, all have a bearing on loss ratio. Raman, would you like to expand on it?
Yeah, I think thanks, Srini. I think from a risk selection perspective, nothing has really changed for us. It's only about getting deeper into the market, whether it's the dealer side or otherwise. That's the only change. Like I mentioned, it's the result of the expansion and the penetration which should be focused on. But from a risk selection perspective, we've been quite healthy vis-a-vis rest of the market, and nothing really changes there. So it's not that we've relaxed some of our norms and hence got into some lines of business which we wouldn't have done earlier. That's not the case. It's largely coming from the fact that we've done some amount of expansion on manpower, on geographies in terms of infrastructure, and added many more agents. And because of this, you see a deeper penetration. Otherwise, nothing really changes on the quality of the portfolio also.
Sure. And just lastly, the data keeping question. One is that what is the advance premium for Bajaj? And secondly, the disbursement number, I think you shared, I missed those numbers for the Bajaj Finserv markets disbursement for the quarter, and then credit cards originated for the quarter.
Nitish, I already gave you the disbursement number, which is in the first quarter was 1,447 crores. and we sourced 74,000 cards. 1,427 crores. Last year was 1,313 crores. The same quarter.
On the advanced premium side, the number for us for June 30th is about 1,678 crores, which is moved up by almost 44% from 1,168 crores on June 30th last year. And this, like I mentioned earlier, repeatedly, sorry, but it's happening largely because of the two-wheeler business, where the advanced premium has really grown at 58%, and also on four-wheeler new business, where it's grown by 21%.
Thank you, sir. Thank you. That's it from my side.
Thank you. We have the next question from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thank you for the opportunity. The first, I have two questions on Bajaj and a question on BALIC. So on Bajaj, just wanted to understand that our retention strategy seems to have changed meaningfully compared to what we were 2 years back. Even in the retail lines like motor, we seems to be retaining less compared to what we do in the past, and given our solvency is very strong. Just wanted to understand the entire logic of having a strategy very different from what we were 2 years back on retention across the product segments. That's point number one. And the second question what I had is that is with respect to EOM, basically that we are the market leaders in the crop business, and EOM in my view will impact most of the crop business. If a company wants to chase that particular product, so given you have already might have bidded for Kharif, so I just wanted to understand what you are picking up at the ground level, whether EOM is impacting the pricing or anything on crop where we are always market leader and it has been a profitable product for us. That's on Bajaj. Maybe afterwards then I'll ask on BALIC.
On the reinsurance, while we can't disclose the complexities of the strategy that Bajaj follows, there are many layers of treaty. We have a base treaty, we have a catastrophe treaty, excess of loss, we have excess of loss for certain lines, and we have proportional treaties for majority of the lines, and we continue to increase capacities as and when the reinsurance markets allow us. Having said that, within our retention, which are fairly high, because of our large spread of banca business and our large retail spread, we do have several sub-treaties specifically for certain products for certain periods of time, and that is how the retentions can vary across years as well, even on the retail lines. Raman, would you like to add on to that and anything on the EOM on crop insurance?
Yeah, I think you rightly articulated the retention part without raising too much of detail. I think you rightly responded. I think, Sanket, the only additional point I'll make is, some of these businesses, have been under stress. And many of you all have mentioned it also that, some parts of motor, because of the high level of discounting and commercials, have been under stress. So that's one of the strategies we are trying to, manage by managing our retentions in a particular way on particular portfolios. But like Srini said, can't divulge too much of the strategy, but that's something which we are working on. On the crop business, you're absolutely right, and that's what I mentioned a little while earlier also, that we are seeing a lot of stress on the crop business, especially from some of the private players who've been facing some stress on EOM regulations, and also from some of the PSUs. So the level of activity has indeed gone up significantly, and it has a bearing on the pricing. But some of the tenders have already been closed, and from our perspective, I think while this year may pass through with similar levels of numbers which we've done in the past, but year on, I think it is going to be a stressful situation, because that's one arbitrage people really have clearly identified, and started to focus on. So we'll have to wait and watch what happens here on. But at least from our perspective, this year maybe we will clock similar numbers because some of the tenders have indeed got closed. But here on, you're absolutely right that there is likely to be stress even on our numbers from a crop perspective.
See, there will be a bit of paradox, Sanket, on this crop business because a lot of the players who are traditionally keeping away from that will now do it for top line to increase their EOM expense allowance. But in the process, they will bring down the prices as though the premium will drop. Secondly, many states have already gone to the 80-110 model, which means that the premiums anyway will have to drop. So overall, the benefit they expect may not come through, but people like us who are in the crop business will wait and watch and keep tendering on where we feel a better opportunity. For us, I think as of FY23, even including crop, we were well below the EOM limit. So crop was not required for us to achieve the EOM limit, and hopefully Bajaj will continue that cost leader among the cost leaders.
Yeah. I understand that point, Srini and Raman. The only reason I was asking this question is that the geographic diversification was the biggest crux for us to be profitable in this particular line. And given the EOM, whether we will be able to achieve that geographical diversification of the intense competition which we achieved in the past. That's the only reason I was asking this question.
I think Raman already answered that. Next year will be a better time. This year already closed and we have got reasonable amount of diversification.
Got it. And on BALIC, see, the obvious question is again on the margin and related growth. So margin compressed. Maybe you kept IRR on the higher side. Maybe to achieve the growth. Even despite that, our growth and launching ULIP was 15% growth reported in the quarter. So if we are taking a cut in IRR and given incrementally Axis Bank will be a bigger base, and if we intend to defocus a bit on ULIP, then the growth what we have delivered in last few years could come down. Is the point you wanted to check? What exactly you are thinking on growth and how it will be delivered?
Broadly, before I pass it on to Tarun, I will just give one comment there that the first quarter contribution to NBV is hardly 15% last year. So out of that, because as I told you, because it's a quarter where you can try different things, and as Bharat mentioned earlier, a lot of actions have already been taken, and on a YTD basis, have already bring it back to where it was. Tarun, would you like to take the rest of it on, whether it's impact on growth and profitability balance?
Absolutely. See, Sanket, the Q1 has to be seen in the light of a 81% growth of Q1 last year.
Right.
On a CAGR, we remain the highest in the industry on IRNB at 46% and GWP of 34% over 3 years. So I would not worry about growth. Our standard answer on this and more than that, the delivery has been we'll be easily growing more than double of the private sector. So I think that I want to allay your worries. You've gotten specific on a few bits, but let me just say more. The intent this quarter really was to widen our product offerings. And as non-par in March and par as well had reached a certain peak, it was a challenge the entire sector saw, and you've seen it in the growth of the sector as well. It's been quite muted. On trying to get people back in the market, talking to their customers, which they had they felt that they'd already met their non-par par requirement. Hence, you see the impact on the overall growth of the sector. Some companies may have grown because of various base impacts here and there.
Right.
For us, the objective was hence to pretty much launch a offering which widened our offerings free every month. So we've launched like 4 offerings and we've largely done significant there. So you've seen the launch of a ULIP plan in April. In May, the small cap fund, which were ULIP, and then the diabetes term plan, which we're getting some significant reviews, positive reviews, and experience has been very encouraging. And in July, I can disclose that the ACE plan, which is a PAR plan, has had a good takeoff. So PAR is kind of right up there, and you'll be settling back to what it had to. I think Srini's already talked about the fact that Q1 is a good time to re-engineer and relook. So that we've achieved. We've become the third largest in the private sector in terms of number of customers that have been added in Q1. So after two bank-owned significant number one, number two companies, and we're very happy with that. Honestly, I've achieved what we wanted strategically. In terms of distribution, which we've been adding a lot many bank assurance partners, albeit not as big as Axis. Axis has grown by about 8%. Our contribution to our business is down from 25 to 23. And if you remember in the previous calls, I've always been saying our endeavor would be never to depend on one bank, unlike other companies, and we would want it to be in the range of 20-25. So versus the company growth rate, actually Axis growth rate is for us has been low. But having said that, we will of course want our customer penetration to be far higher in the Axis array, and that shall remain. Our base is getting higher, so don't expect the growth like last year and the CAGR that you've seen over the last 3 years, which has been the highest in the industry at 36% and thereabouts. But given the width of our other businesses, other than just Axis, there has been PSF is expected to grow near double of the company growth rate. Our agency has beaten the trend year on year. We are expanding our branch network further. Even in our institutional business, the kind of partners and the array of partners with this 3 to 9 gives us a good platform to extend further. And the engine getting all this moving is really our focus on data and technology. So that remains. And with that now, the product innovation that is kicking in as well. I'd say it as a success for last quarter because we've seen significant take-up of each of these. So already these offerings, like within a very short time, has already been significant part of our product mix. So that there is distribution gets more and more things to go and get a higher share of the customer wallet. I hope that answers your question.
Yeah, perfect, sir. Perfect. Thanks. That's it from my side.
Yeah.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity and a very good morning. So a couple of questions on BALIC. First of all, the VNB margin, the 12-month number that you have shared in the presentation. So that being stable, I just wanted to understand what would be the role of expenses in this number. So maybe some color on how it would have moved pre-cost overrun versus post-cost overrun. And because I think that since the scale has gone up, there might be some benefit that might be coming out of the expense ratio. So some of your thoughts on that. Secondly, in terms of the non-par category, if you could highlight if any impact you are seeing because of the taxation on 5 lakh plus policies, how that is being handled, and whether we are seeing some amount of sales that earlier would have happened in the non-par category being moved to other categories. Because I think in terms of proportion, the number is fairly steady. And also wanted to understand what is happening in the annuities in the individual business because the number looks tepid for this particular quarter. So that's on BALIC. I have one question on BALIC and then I will come back after the response of this.
So let me take the last two, and then I'll ask Bharat to come on, adding on the expenses and any further thing that he might have. See, on the annuity side, I think it's a natural flow of business. The base has been in the 5 to 8%, and it will remain broadly there. We don't see a big shift in any form whatsoever. Of course, annuities are getting now relatively, given the tax equality now, all across, maybe relatively more attractive versus the others. Now, we were the first ones to launch the deferred annuity, and we shall remain focused on that segment. It is also a non-medical product, which makes it quite easy to sell. That shall remain, but I do not expect this to significantly change from, what where we are. Ballpark 5 to 8, maybe sometimes 10%, but that's the whereabouts. On the 5 lakh and above, yes, there is an impact there for the entire sector, and which is exactly why we chose to widen our proposition base, and we've successfully done that. There are some exciting thoughts we have and things we are going to be rolling out in the next 3 to 4 months to be able to take benefit of that. Because although 5 lakh and above, the taxation is put on life insurance companies for par and non-par for the customers there. But having said that, still the ability to structure that in the customer's favor through products is significant, and our par product, for example, allows that quite well because you can actually structure when the tax is going to be coming in. So I do see an impact on the sector, but I think the sector has enough tools available with itself to get that sorted. The good thing is that now above 5 lakh, we remain possibly the only product range which does have the capability of helping the customer in their tax planning versus any other product in the entire financial services side. So that should finally, I think you should assume this year is the year where the base will get settled in and it'll sink in with the customer, HNI customers as well, and then should sort itself out after this year. Bharat, on the expenses or anything else you'd like to add?
Yeah, thank you, Tarun. See, so the question was on the overall margins and the overruns. Just to be clear, see what happens with the overrun. Like as we are adding new partners, as Tarun and Srini also mentioned, we recently added 5-6 banks, and they are in the early stage or even early months of the operation. They will always produce an overrun. So technically, overrun is also like a rolling number. As we add more partners, initial period they will give overrun by the time they become a complete number. But on the overall basis, if I take steady state that where we are, maybe the overrun could be in the range of 5 to 6%, which is already there. But this can improve significantly even in the next quarter, next year, or it can be there if we start adding more partners. So I think having any number of overrun to me does not suit a business like BALIC, which is as of now adding, growing, and adding new channels, not only on the third party side, but if you look at our own agency side, we are expanding, we are getting into new territories, we are getting into new sub channels. All they are in the initial stage will always add to an overrun. So I think it's just a way of looking at what is overrun. To me, it's not the best metric to see as of now for a company like BALIC, which is adding on to the partners.
Let me just add to that. You asked about the 12-month rolling margins, and the reason we report 12-month rolling NBV is precisely because the life insurance is very seasonal. The fixed expenses are pretty constant, but the top line is varying from Q1 to Q4, and last year specifically Q4 was very high. Therefore, the rolling 12-month gives you on a rolling basis, on an annualized basis where we are moving without annualizing in terms of assumptions about future margins. This is a disclosure we started doing just to give the benefit of this. Secondly, the company's goal is to grow its NBV. See, this business has got multiple lines with different capital requirement, different levels of risk, different levels of profitability, and one margin internally for us does not indicate what it is, but NBV does, because that is the absolute amount of money you're making. So the company has the flexibility to grow certain high margin business or low margin business, high volume business, or channels, focus on something more or less. But at the end of the day, we should grow our margins at least at the same rate as IRNB, or better if we can. Historically, last 3 years we have been doing better than the growth in the IRNB. So this will continue. We have transformed the company from where it was, from a negative margin to a fairly healthy double-digit margin. We have some way to go, and over the next few years, you will see this playing a lot more effectively.
Understood, sir. So if I were to think about the margins for the full year, how would your guidance be? Would it be at a similar level to last year? Because I think for FY23
we wouldn't give a guidance on margins, as I told you, but you can assume a certain growth in NBV. You know what our past trend is, but we normally try to avoid giving any guidance on profit.
Understood.
Just to add to Sydney, as Sydney rightly said, we do not give NBM margin. What we look at is NBV as an absolute value. Even if you look at our 12-month rolling NBV, this quarter, if you look at on the 12 months to 12-month basis, has also gone up by 24%. So margin is a different way to look at it, but absolute NBV has grown by 24% on a rolling 12-month also.
Right, sir. So just a quick clarification on that. So if I were to think only about the fourth quarter for this year, then it might not grow as much as what we have seen in first quarter, right? Because of that.
For the industry, yes. For the industry as a whole, yes.
Okay, understood. Couple of queries on the general insurance side, if I may. So first of all, your loss ratio number for the health insurance segment has worsened compared to last year. So just wanted to understand, what is causing that, because first quarter is generally more benign in terms of claims that come about, and it is generally from second quarter onwards with monsoons, etc., it starts to increase. And if you could also split out how the experience has been between retail and group. That is one. And second is, in terms of the Geo initiative, if you could quantify, what proportion of your premium right now comes under this Geo initiative, and any kind of quantification on what additional growth it is bringing. So that will be very helpful. Thanks.
Raman?
Sorry, I didn't understand the second question. Can you just repeat?
Second question is how much we are getting from Geo. I don't think we want to disclose that number, because it's just a general initiative on a geographical basis of expanding rural and semi-urban areas.
Yeah. So I think Srini is right. We just started the endeavor to expand, and like we said earlier, we are adding many people and infrastructure in these locations. So as of now, we've just started the journey. I think it's only been 2 quarters, and we are adding about 100 plus branches this year. So I think it's too early to even start discussing those numbers. While the numbers are good and the growth is pretty healthy, but maybe it's too early to start talking about that. And the health piece, I think it's the result of the mix of the portfolio between retail and group. So there are 3 parts. While we've not done any government health business in this quarter, but there are 3 parts. One is the GMC, then there is the non-employer employee, more linked to your lending business, and then there is a retail health, absolute retail health. The loss ratio has actually moved up in few accounts in the GMC side. While they're still profitable, but it's moved up compared to where it used to be, and we've seen some hardening of rates happening there, which we had mentioned also last year, if you recall, that the benefit of the pandemic is probably going to be sustained for a short time, but the rates will start hardening in due course, and I think that's the reality of life. On retail, while the loss ratios have not changed too much, but they are on the higher side, and it's something to do with the way the claims are being reported by the hospitals. And so we've enhanced our diligence significantly in Q1. Now, every retail claim, whether it's cashless or reimbursement, goes through investigation process. And we are hopeful that some amount of fraud which we are seeing on the retail portfolio should start coming down. And I had made this candid comment last quarter also that while on the motor side our anti-fraud processes were very, very robust, on health, given the nexus we were seeing between hospitals, doctors, and other parts of the ecosystem, it was very difficult to crack that code. I think that's something which we've now started focusing on. And like I said, during the quarter, we've made a change that every claim now is getting thoroughly investigated. Every admission in the hospital is being physically verified or done through a video call and so on and so forth. So hopefully in the next quarter onwards, we'll hopefully start seeing some benefit of that accruing. So that's just to summarize what's happening on the health loss ratio.
Understood, sir. Would it be possible to just even in ballpark give some idea about how the retail loss ratio has been vis-a-vis, say, group employee or the credit-linked business?
Sorry, your voice is not very clear. Can you just repeat what you said?
Yeah, sir. So I was asking that if you could give some color on how the loss ratios has been in retail versus the two group lines that you had mentioned, even in ballpark will do.
So I will not divulge the numbers of these and indicate you that the best benchmark of that is comparing with the SAHI company. We're a little on the higher side for two reasons. One I just mentioned. Second is the mix of our new business was on the lower side. As we all have seen that the growth for the SAHI companies has been far better, and hence the mix of new business has been on the better side for them versus us. And that's one reason, in addition to what I mentioned, our loss ratios are a little higher compared to the SAHI companies. But like I said, we are working on that, and in due course, we should start seeing the results of that. And also just to recap what we've mentioned in the past is that we've now set up a separate SBU for health, which is headed by a very senior person coming from Apollo Munich. And the gentleman is leading the portfolio to include all aspects of health business, whether it's distribution or products or underwriting, claims, and so on and so forth. So with this enhanced focus, we should, see some benefits accruing on the retail side. Well, a lot of work has been done by the gentleman on the non-employer employee, which is, the credit linked scheme. And there, our growth is very healthy at upwards of 30%. DMC also, they've done a great job. Retail is where we are now investing in. And hopefully you should start seeing some results in our quarter.
Yeah, very clear, sir. Very helpful. Thank you so much and all the best.
Thank you. We have the next question from the line of Nischint from Kotak. Please go ahead.
Thanks for taking my question. Most questions are answered. Just in continuation of the last one, what proportion of group health would be credit and what would be employer-employee?
So I'll not share too much of data, Nishin, but the ratio would be 2:1, 2 being with PMC. So that would be the number.
Sure. Thank you.
Thank you. Ladies and gentlemen, with that, we conclude our question and answer session. I would now like to hand the conference over to Mr. Akshay Jain for closing remarks. Over to you.
Thank you all for joining the call, and thank you to the management of Bajaj Finserv Limited for giving us this opportunity to host this call.
Thank you very much. Ladies and gentlemen, on behalf of JM Financial, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you all. Thank you.
Thank you, everybody.
Thank you, sir.
Thank you, everyone.
Thank you.